So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity is coming into the market. Some of these lag, commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle. Yeah. So we've got a really nice period ahead of returns. Don't forget, step back, all of the noise you read, all of the stuff, rates are at 5.5%. Headline CPI is at 2.5%. Trueflation, which I think is built on Chainlink.
Yeah, that's right.
Is at 1%. Right? Rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great.
On Wednesday, the U.S. Federal Reserve announced a 50 basis point rate cut, marking its first since March 2020. Leading up to the decision, analysts were divided on whether the Fed would reduce rates by 25 or 50 basis points, with most expecting a smaller cut. In its statement, the Federal Open Market Committee cited progress on inflation and balance risks as reasons for lowering the federal funds rate to a target range of 4.75% to 5%. The committee also emphasized that it will continue to assess economic data and risks before making further adjustments. This rate cut has been eagerly anticipated by global markets, as investors, traders, and fund managers have been watching closely since the central bank's aggressive rate hikes began in 2022. According to Real Vision founder and CEO Raoul, this move signals a favorable shift in global liquidity conditions. With the Fed delivering a larger-than-expected cut ahead of the November elections, Powell believes it will lead to a significant boost in asset prices. Powell, a prominent macro analyst and former Goldman Sachs executive, predicts that tech stocks and cryptocurrencies, both of which have outperformed the Fed's balance sheet, will benefit the most from the liquidity influx. He forecasts that crypto prices will quadruple by the end of 2025, rising from just over $2 trillion to between $10 trillion and $15 trillion, with a further climb to $50 trillion to $100 trillion by 2030. Powell shared these insights during a recent fireside chat at the Enterprise Cayman conference, where he discussed the current state of global markets and his outlook for the future.
How I look at markets is I use a combination of the long-term secular trends, what things are trending over time, then the business cycle, and then liquidity. And I found over the years my framework's been adapted as I've understood more and more that liquidity has become almost the total driver of returns. And then you get some excess returns for secular trends. When you break down what I mean by all of that, the business cycle, as we know, goes up and down. You can use the ISM as a way of understanding the business cycle. We're currently at the turning point of the business cycle, where on a forward basis, we should see the economy improve. So the calls of recession stuff, that was from 2022. Right now, we should be seeing expansion on the road ahead, whilst the rates are coming lower. What I found in my work over the years is I uncovered something that I refer to as the everything code, and which is a bit of a kind of hubristic title, but it was really shocked me. I think I was one of the first people in the world to find that what had happened back in 2008 was we had a global debt reset. As opposed to a debt jubilee where you don't pay any of the debts back, you had an interest rate jubilee. And so what happened is all of the major central banks and governments around the world agreed not to pay interest. That's what zero interest rate policy was. We kind of were sold that it was a story of we need stimulation. It was not stimulation. What it actually was a jubilee and you don't need to pay your interest rates. Why? Because all of the governments around the world have got to 100% of GDP in debt. Now, when you're 100% of GDP in debt and you have an aging population, you tend to have slow GDP. So GDP, trend rate of GDP in the US, about 1.75%. Let's call it 2% for easy maths. And let's say average interest rates over the last 10 years have been 2%. So 100% of all economic activity goes to pay the interest payments on the debt. Issue is the corporate sector is over 100% of GDP in debt. This is the only game. Everything else is irrelevant. Every single asset class, every single economy, every single central bank is all highly correlated based on this debt cycle. Why this debt cycle? Well, back in 2008, everybody reset their interest rates to zero and then restructured their debts, maturities, at all government level from 3 to 5 years. So you've got a 4-year cycle, and it's perfect. It's also exactly what happened in the 1950s after World War II, because we had the same issue then, and we did the same thing then. And as opposed to zero interest rates, what we used then was yield curve control. But what they're doing is every time the debts come due, which is this year and next year, we've got 10 or 11 trillion in the US alone of debt to roll over. They print money in the form of liquidity. It's not just the balance sheets. Every aspect of liquidity you can find in the system, they understand the game. They all do it together. And they're doing it now. So liquidity is the driver. So when you start adjusting markets, this is the magical thing. Once you adjust the S&P 500 by Fed net liquidity, the largest measure of liquidity in the US, the S&P 500 has gone nowhere since 2008 and 9, because it fell in 2008. It's gone nowhere, almost zero returns in real terms. Gold, same. Real estate's different because you use leverage, but if you would use unlevered real estate, it's gone nowhere. In fact, no assets have gone anywhere except 2. There's only 2 assets in the world that outperform debasement of currency. Debasement is the excessive printing of currency to pay your own debts, using a credit card to pay a credit card, for example. It's only technology, and it's only crypto.
According to Raoul, after multiple rate cut announcements from the Federal Reserve and other central banks, we are entering what he calls a phase of more cowbell, signaling an inevitable wave of heavy money printing to prevent the collapse of the global financial system. Powell believes this liquidity injection will flow directly into markets, particularly the cryptocurrency market, which is notorious for its extreme volatility. Following Wednesday's rate cut, Bitcoin exhibited this volatility, jumping from a 24-hour low of $59,212 to a high of $61,500 within minutes of the announcement. Powell predicts that when central banks begin significant money printing, possibly in 2025, Bitcoin and other cryptocurrencies will experience even greater upside volatility. He foresees Bitcoin gaining thousands of dollars in value in a single day during this phase. This period, which Powell refers to as the banana zone, marks the phase of every crypto bull market where prices soar to seemingly unbelievable levels, or as he puts it, go bananas. Powell asserts that we are just entering the beginning of the banana zone, and much more explosive price action is yet to come.
So where we are today? Well, liquidity, being the main driver, leads the business cycle. It bottomed in exactly the same time the NASDAQ and crypto bottomed, which was October, November, December 2022. And it's been going up, and those markets have gone up. The other and they lead because they follow liquidity. Most other instruments, the Russell 2000, oil prices, copper, they tend to be living in present-day business cycle, which is today, which is just picking up. So you're starting to see commodities still rock bottom, starting to pick up. You're starting to see Russell 2000. You're starting to see the equally weighted S&P now all-time highs. You're starting to see that happening. So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity's coming into the market.
Over the next, I guess, 15 months.
15, and some of these lag, commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle. Yeah. So we've got a really nice period ahead of returns that we can all call ourselves geniuses. Don't forget, step back, all of the noise you read, all of the stuff. Rates are at 5.5%. Headline CPI is at 2.5%. Right? Rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great. And the cycle will repeat. 2026, the cycle slows down again. And then we go through the same debt refi cycle all over again. Oh, and the other function of this is financial conditions are also easing. Financial conditions, we find the best measure of financial conditions is the dollar, which has been weakening. It should do at this point in the cycle. Commodities, which have been relatively weak, which is great. Normally they'll start picking up very soon. And then rates, which will come lower. So we've got financial conditions easing, the Federal Reserve easing, most of the central banks easing. We've got stimulus coming from almost everybody. The Fed, less so yet. The Chinese are leading it because they've got the slowest economy. So it's all to look forward to. What's become obvious is I talked about this theme of debasement, and there is, I call it a supermassive black hole. Right, we're all used to, many of you CFAs in the room, and we're all in the investment world, and we're used to diversified portfolios. It's kind of a weird world. Everything's correlated to this liquidity cycle. They either lead or lag. That's it. That's all you've got. That's the only tools you've got to play with, unless you're dealing in alts. Even most alts are actually still correlated to the business cycle, which makes it a problem for people in how to think about this world. But I have done the terrible thing of just saying, well, if it's all correlated, I just want the best risk-adjusted asset class there is. And once you actually do the work on it, bizarrely enough, it's crypto. The most volatile, the thing that falls 80% every 4 years. Every 3 years, crypto is the best performing asset class. Every single year, every single 3 years, until the year, 2 years after the US election. This is this debt refi cycle, and it's always the worst. And in the worst, it goes down 80%. Most people would say that is an uninvestable asset. How can you possibly buy something that goes down 80% every 4 years?
It's been roughly 15 hours since the Federal Reserve's announcement, and Bitcoin continues to show strong upward momentum, likely fueled by the Fed's larger-than-expected rate cut and Jerome Powell's unexpectedly dovish comments. During his press conference, Powell described the half percentage point rate reduction as a recalibration of central bank policy, noting that future decisions will be based on evolving economic data. He also emphasized that neither he nor other Fed officials believe the rate cut increases the risk of an economic downturn, stating, "I don't see anything in the economy right now that suggests the likelihood of a recession is elevated." Powell continued by highlighting key indicators: solid growth, declining inflation, and a strong labor market, all of which support his view that the economy remains stable. At press time, Bitcoin is trading above $62,000, its highest level in nearly a month. Do you think the Fed's announcement will continue to influence Bitcoin and the broader crypto market? Feel free to share your thoughts, along with any comments on Raoul's analysis of the current crypto market and the global economy. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.